All right. So, guys, today's training, for those of you that don't know what is a financial needs analysis, right? Also known as an F.N.A. We're going to break down how to conduct a simple F.N.A. for your client that is simple, it is clear, it is fast, and it is doable for everyone to do it. And if you master doing this F&A in this manner, you will give your clients and your business partners and students a great experience as they learn along the way, right? So for those of you that don't know who I am, my name is Coach Keyon, also known as Mr. Finance, your favorite financial educator and business coach. I'm a regional marketing director here at the Hedgeman Group International, and I'm here to teach you guys how to conduct a financial needs analysis, right? So first thing first that we got to understand about doing a financial needs analysis, you got to understand what is a needs analysis. This is a needs analysis that helps us to conduct solutions, strategies, and options for you to get better with your finances. It's our way of helping you to, number one, understand why you need to make more money. And then it's also show you how to save more money. But our goal is to make sure that you have a stronger financial foundation. And the plan is to make sure that you learn how to protect that money. So you're going to learn why you need to make more money, how to save more money. The goal is to make sure you learn how to grow your money. And the plan is to teach you how to protect that money, right? And that's the reason why we do that financial needs analysis. So on this screen is a QR code. If you scan this QR code right now, it's going to share and give you access to complete our needs analysis. And today I'm going to show you why you need to get that done. So here's the question I want you to think about. What concerned you about your finances based upon our economy today? What is that as a concern to you? Whatever that concern is, I want you to share it when you scan this QR code, right? Share it on there. Let us know what's your concerns, because I guarantee you that we are able to come up with some solution to that concern, right? And we're going to make sure that you get literature and understanding and mentorship through this whole process. I guarantee you, you will learn about finance. As long as you are teachable, coachable, and reliable, I guarantee you, you will learn about finance. So let's talk about what is a needs analysis look like, right? So when we do what's called a financial needs analysis, guys, it's important that you understand that we empower families by teaching them how to make, save, grow, and protect their money so they can build generational wealth with confidence, but most importantly, clarity. Okay? Clarity. That's the most important thing here, right? Clarity. So when you have clarity on why you need to make more money, then it's easy for you to learn how to save more money, right? But what's the use of saving more money if the goal is not to grow your money? And what's the use of growing money if your goal is not to protect your money? That's what the needs analysis is for. It's to help you to understand why these four things is important, but how we're going to get them done. So when you look at your financial needs analysis, and we start breaking down this simple intake form. This simple intake form requires us just to gather some basic information from you. Basic information with some homework, right? So when you meet someone for the first time, our goal is to make sure that one, we want to know what's your name, what's your date of birth, are you a smoker or a non-smoker, what's your spouse's name, what's your spouse's date of birth, is he or her a smoker or a non-smoker, what state do you live in for your address, what's your cell phone number, what's your email address, what's your kid's name, date of birth, and gender. That's all we need to know in that very first top section, right? But when we start looking at things like, your future goals, we're going to start talking about what age would you like to retire? Because if we find out what age you like to retire or your desire to stop working for money, because we understand that some people don't want to retire, so you got to understand that some people have the desire to stop working for money. Well, then you need to know your FIN number. And the question you got to ask yourself is, do you know your FIN number? Now, what does your FIN number stands for? It stands for your financial independent number. This is your financial independent number. And when you have a financial independent number, it helps you to know how much you're going to need in order to retire comfortably. And it also helps you know how much I need to save in order to reach that goal. That's what the FIN number does. And then also, we're going to talk about, do you want to become a homeowner? Do you need long-term care? Do you want to retire your parents? Do you want to put together college education planning for your children? And also, when it comes to going on vacation, where's your dream destination you'd like to travel to? These are future goals. But most importantly, when it comes to your retirement, do you know how much you need in order to retire comfortably? And do you know how much you need to save to make it a possibility? Right? That's what your FIN number. We're going to talk about that today as well. Also, when you look at this intake, we're going to ask you another simple question, right? We're going to talk about what is your monthly income, and we're going to talk about what is your total monthly expenses. On the first time when we meet, our goal is to go over these two things with you, right? We're going to break down those two simple things with you so then you understand how to put together a budgeting formula. You got to remember this. When it comes to putting together your budgeting formula, guys, when we sit down with the person, all we need to know is what is their net pay. What is their net pay? How much you're bringing in after taxes? And also, when it comes to discretionary income, what is it that you're making outside of that, right? So if you have a job, and if you're someone that's receiving, like, let's say, government assistance, or if you're receiving an alimony or a child support, or if you're receiving a settlement, right, or Social Security, that is considered discretionary income outside of your current net pay. Now, if you're an entrepreneur and you're listening to this, you're probably saying, well, I don't have a net pay. I have a gross income. Same thing. What is your net income, right? What is the income that you're bringing in? And if you have something outside of that, what's that discretionary income bringing in also? Now, the next thing we want to know is, on the first time we talk to you, we're not going to ask you all of these following things. You're not going to ask the person what's their rent, what's their mortgage, what's their car payment on the first time you meet them. Most people don't have this information. That is too much information. TMI. Okay? All you got to simply ask the client is simply, give me a rough estimate of your total monthly expenses. A rough estimate. Now, if you want the precise number, give them this homework. The first homework that the client must have is, number one, they need to write down the name of all their monthly expenses. Write down the name of all their monthly expenses. That can be rent, car note, water bill, right, credit card payments, right? Write down the names. Number two, they must write down what's the amount of the bill that is due. So if it's, for example, rent $1,000, right? Car note $300, right? Write down the amount. But the most important one that they must write down is the due dates. When are these monthly expenses due? Write down the due dates. Those three homework that you give your client will have them start doing what's called an audit. They're going to start auditing their accounts. And when they come back with the precise number, now you could also run a precise budgeting plan with them. You could use that 50-30-20 budgeting formula. That's going to help them to know how much they should be saving first and how much they could spend after, not the other way around. Not the other way around, because in most scenarios, what most people do, they spend now and save what's left over, right? So we're going to show them how to put that together properly using the formula. Also, when we go over their assets, okay, when we go over their assets and we start talking about their liabilities, guys, when you fill out a client's asset section, please don't ask them for the numbers. Once again, TMI, okay? They don't have that clarity at this point. But you could ask them as far as what is the market value of their home. If they're a homeowner, write down yes. Do you have a mutual funds or stocks? Yes. Do you have life insurance with cash value? Yes. Do you have a savings account? Yes or no, right? So these are yes or no questions that you're asking. Do they have a checking account? Yes or no. Do you have a retirement plan? Yes or no. Do you currently have any cryptos? Right? Yes or no. Right? These are yes or no questions. because what that does is that it helps you to know, hey, ask the following question. Do you have asset protection? And we're going to talk about that some more throughout today's training. But even when it comes to the liability section, guys, once again, do not start asking them how much debt do they have in each category. TMI, all right? Remember, that's TMI. It's too much information on the first meet. Just ask the client what's a rough estimate of the amount of debt that they have. So let's go over the next two homeworks, right? The first homework that you're going to give, the second homework that you're going to give them is comes to the asset section. Whatever they say yes to as far as assets, so if they said yes to, they have a market value on their home, or they said yes, they have a checking and savings account. The homework is for them to write down the following things. Number one, which financial institution are they working with, right? That's the name. So that if they, for example, if they said yes to a cash value life insurance, what's the name of the insurance company, right? Now, the second thing you want to find out is what is the value that they have in each components that they said yes to. So, for example, if they said yes to their checking account, well, how much is in your checking account? So that's the second homework that you're going to give them. The name of the financial institution and what is the amount that's in the institution, right? So, for example, if they say yes to a retirement plan, who is the financial institution that's managing your portfolio and how much do you have in there? What you want the client to do is to become a lot more aware of their finances, because sometimes we just blindly think everything is okay. All right. So that's the second homework. The third homework that you're going to give the client is pertaining to their liabilities. So, for example, there's four things you want them to write down when it comes pertaining to their debts. Four things. So this is the third homework. The third homework is number one. You want the client to go there and go write down, number one, what's the name of all the creditors that they owe? That's the first thing. Number two, you want the client to write down what is the balance upon what they owe. Number three, you want the client to write down what is the APR, which is the interest. What is the interest upon their debts? And number four, what is the minimum payment that is required? All right. What is the required? Not what they're paying, but what is the required minimum payments? If you're able to do this and give your clients those three homeworks, that's something that they could go work on and get that done for you, within the next 24 to 48 hours, right? They get that done while you're working on the information that they already gave you and so on. Now, with that, it helps you to establish a financial foundation for them, because that financial foundation is going to talk about putting together protection for them. You're going to learn how to manage their debt. They're going to learn how to create an emergency fund and how to start save to invest. Now, ultimately, guys, when someone say, hey, how much can you comfortable afford to set aside each month for your goals? And they tell you, hey, I could put away 200, 300, 400, 500. Let's say they could say they could do $1,000 every month. Do not automatically think that you should put that money into an IUL. Do not be an IUL junkie. Okay, that's my new terminology for that, by the way. Do not become an IUL junkie. Don't believe that every dollar that a person can save should go inside of an IUL. All right. Make sure you do a proper financial foundation for them. Make sure that you're able to establish estate planning, right? To protect their assets, to protect their estate, right? So we're going to talk about a full comprehensive financial foundation and also asset planning, estate planning, because we need to make sure that our clients have wills, power of attorney, healthcare directive, and trust. So there's two things that their money should really provide for them. It should help them to establish a stronger financial foundation and estate planning, not just an IUL. All right. So we're going to talk about that. We're going to talk about this some more and go over it and help you guys to have a clearer understanding on this. Once again, if you scan that QR code right there, it's going to be available throughout this entire overview. So that way you can scan it and you can start working on your personal financial needs analysis. So here's the thing that we're going to look at. Do you know your F.N.A number? right? It comes right back to the very same thing that we gather. So when we ask someone about retirement, at what age do they desire to retire or stop working for money, that's going to help us to establish their fit. So how do you know your fit? Your fin is going to help you to know what is your now, your later, and the end. Now, what does that mean? What does now, later, end means? Now, when you're doing it, you want to write it down just like this on your piece of paper, by the way, for the client, right? Because now you gather all the information, and now you're going to sit down with your trainer who has the experience, right? It's not for you to figure out, but it's for you to know how to do. Now, when you sit down with your trainer is going to show you how to write it down just like this: now, later, and the end. Now, by doing so, the later represent their retirement age, which is what you would have gathered on this information here when you did the F.N.A. And by knowing the retirement age, you would also know what's the life expectancy. Did you guys know that the average life expectancy for someone is 85 years old? And it's very crucial for you to know that. Then the now stands for their current age, which you would have either gathered that already from the previously when you asked for the client's name and date of birth, right? So you should do the FIN number for not only your client, but also for their spouses. Okay? Do it for their spouse and the client. So that way both of them know what's their FIN number. And it's very, very crucial that you do that. Now, let me give you an idea of what the FIN looks like when you put it all together, right? Here's what the FIN number looks like. When you put together the FIN number, I'm going to give you an example of a male or a female that wants an income of $5,000 starting at age 65 during their retirement. All right. So that's what we're going to work with today for an example. Now, we already know that life expectancy is 85 years old. All right. Now, what if they live beyond that? That's another conversation, but at least we could show them on an average what it looks like. Now, you're going to write down now. You're going to write down later. You're going to write down the end. The first thing you're going to figure out is the later section, the retirement age. So if the person told you that they want to retire at 65, right? So what you're going to do is you're going to write down from 65 to 85, which you already know what the end is, right? You're going to calculate from 65 to 85, and that is 20 years that this person would need $5,000 every month, which is $60,000 a year that is needed. So when you do the math, you're going to take 60,000, multiply it by the 20 years that they need the money coming in from 65 to 85, which tells you that on an average, the person need $1.2 million, right? $1.2 million. That's what the person needed on average to be saved up by 65 to receive $5,000 a month for 20 years. So when you look at that life expectancy and you realize this, wow, this person need to have that type of income coming in from 65 to 85. So if they don't have $1.2 million saved up by 65, that's the question you got to ask your client when you show them their FIN number. How on track are you to realistically hit that goal, right? And ask them what plan they have in place. What plan do you have? Because when they realize that even on an average, if this person was 30 years old and they're starting out at 30 years old, did you know that the average person starts saving for retirement at 30? So if they were from age 30 to 65 and we have 35 years to save that $1.2 million, so you got to take the need of the $1.2 million and divide it by the 35 years that they have to save it. And if they were putting away, they're just saving straight up in the bank. All right, we're going to talk about what most people do. They save in the bank, underneath their mattresses, or in their checking account or savings account. If you was to do that, you would need to save at least $34,285 a year, or $2,857 a month. That's if you're just saving raw cash. So this clearly tells us why the person needs to invest their money, because saving cash alone is not going to be sufficient. So that's the reason why when I look at someone, I say, what's your plan? What's your plan when I show them their FIN number, right? And you got to ask yourself too, that's listening to this, what's your plan? You run your own FIN number, knowing that you know how to do it. Run your own FIN number and ask yourself, what's your plan? How many more years you have to reach that goal? That's why HGI can be that opportunity. So I don't have to convince somebody why they need to join HGI. I show them their FIN number and tell them Why not HGI? That's something Richard taught us, right? Why not HGI? What else? What other industry is going to help you to make the significant amount of money that you need to make to start saving for your retirement? And you don't have to sell this. This is what people need to know. So here's some questions to ask yourself. How long, number one, how long will I need an income during my retirement years? Number two, do I have enough time to save for my retirement? Number three, how will my money be taxed when I start to receive it during my retirement years? And number four, does working a job alone give me the lifestyle I want during my retirement? If these questions you don't have an answer for, that's a problem. That's what we help clients with. Because even if they had $1.2 million saved up in their 401k, they will not be able to receive $5,000 every month. They won't, because it's going to be taxed. So you got to take in consideration what's your risk tolerance and tax tolerance as you grow towards those needs that you want, right? These are things that we're going to help you and many clients to learn how to do for themselves. But even when it comes to the budgeting, and we talked about gathering the client's income and an estimate of their total monthly expenses. And even when you get the specifics, you could use the budgeting formula. You see, one of the things I want to tell you about budgeting is not about tracking spending. Let's make that very clear. Budgeting is knowing how much can you save or spend before you do either one of them. That's what budgeting is. So that's why you must know the rules to budgeting. You must understand how to pay your bills and take care of your cost of living. You must learn how to save your money and also how much should you be spending. That's what budgeting is all about, knowing these things. But ultimately, let's look at what the budgeting formula could look like for you. Now, once again, budgeting is not about tracking spending. Budgeting is about knowing how much you can save or spend before you do either one of them. I want you to remember that. So when we break it all down, let's look and see here. Let's give an example about Jack and Jill. And Jack and Jill makes about $3,000 a month with a monthly expense of $2,400, right? So in this case, it's fair to say that Jack and Jill can pay their bills. All right? Jack and Jill can pay their bills. That's not the issue here. But you got to ask, what is Jack and Jill's budget? Right? What is Jack and Jill's budget? And it is so important for you to know this. So here's the rules to budgeting. The rules for budgeting and understanding the cost of living and savings and spending is very crucial. So let's look at the rules. The rule says 50% of your income should cover your monthly expenses and bills, right? 30% of your income is for spending. 20% of your income is the minimum for savings. These are the minimum, guys. So what you got to do to run the formula to balance your budget is by learning the net pay multiplied by 0.50 that equals the money for the cost of living. You got to take your net pay multiplied by 0.30 that equals the money that you can spend. Your net pay multiplied by 0.20 gives you the minimum that you should be saving. These are the rules, right? So once you start applying the formula, let's use Jack and Jill. Jack and Jill's monthly income. You need those two things before you can run a budget. You need to know how much income is coming in and what's the total monthly expenses. If you don't have those two things figured out, you can't run this budgeting formula, by the way. So what must you always take? Your net pay. So for Jack and Jill, their net pay is $3,000. So we multiply that by 0.50, that gives us $1,500. So what does that tell us about Jack and Jill? Jack and Jill has a monthly expenses of $2,400. Their 50% does not cover that $2,400, which means that Jack and Jill need to be living on a budget. This is the clearest sign and the clearest indicator that someone could learn that they need to be on a budget. Did you know that 95% of Americans need to be on a budget, but it's only 5% do? 95% of Americans need to be on a budget, but it's only 5% that does. Think about that. Only 5%. But here's another statistics. Only 5% of the population could pay for half of their monthly expenses with half of their income. Only about 5%. And the question is, how much of a desire do you want to become part of that 5%? But now we know Jack and Jill know he cannot pay his monthly expenses with 50%. But now they're going to go back again in the spending box, take $3,000, multiply by 0.30, that gives them $900, right? And in their savings box, they're going to take $3,000 again, multiply by 0.20, they got $600. So now we got all the money on the table. And here's the question that Jack and Jill got to ask themselves. Hey, we got to pay this $2,400 monthly expenses. Where are we going to take the money from? Now, Jack and Jill has a choice. They can either take it from their spending box or they can take it from the savings box. You know what Jack and Jill will do if they're very responsible? They'll take it from the spending box. But what is the reality for many of us? We take it from the savings box and continue spending. We've got to change our habits. That's what we're here to help our clients to understand. It's that their habits is hurting them. It's not that they have lack, but it's the habits. The habits is hurting them, and we need to change those habits. So that's why if we were able to show Jack and Jill how to take away that $900 from their spending box and apply it to their bills box, they could pay their bills. Jack and Jill could pay their bills. And now Jack and Jill could now use what's called the half rule and take that $600 that they have in their savings box and break it down into halves. For example, if 20 equals 600, right? Because that's what that 0.20 means. 20 equals 600. Now you're just going to break up the 20 into half. So you're going to break it up into 10, 5, 5. 10, 5, 5, right? And by doing so, that means that you're going to break up that 600 in the same way. You're going to divide 600 by 2 to figure out what was 10, which is 300 for their retirement. That's the money that you put towards your retirement. And then if 10 is 300, for figuring out 5, you just got to take that 300 divided by 2, and now you got $150 to put towards the emergency fund. And now Jack and Jill know the other 5 that I have is $150 for my spending or apply to debt. Now Jack and Jill know I could pay my bills, I could save for my retirement, I could put money away from my emergency fund, and I still have some to spend and put towards debt. If you don't know those 4 things, guys, how are you going to get better with your finances? And these are things that we want to help our clients to know. So, questions you need to ask. Do I live on a budget? Do you live on a budget? Number 2, are you saving enough for your retirement? Number 3, do you have an emergency fund? And number 4, what is your weekly spending budget? If you haven't figured out your monthly spending budget, then what is your weekly spending budget? Because you got to figure out your monthly, then divide it by 4. Now you know how much you can spend every week or every 2 weeks, right? These are things that we want to help our clients to know so that way they understand how to win. But when we go for their assets with them, guys, and we talk about what assets do they possession, we got to make sure that we ask our client at the very moment that they say yes or no to any of these assets. You must ask them, hey, do you have asset protection in place? In most scenarios, they're going to tell you no. They don't have anything to protect these assets that they disclose that they have. And that's where we come in. We come in and we help them to understand why they need to have a will, why they need to have a trust, why they need to have a power of attorney, why they need to have a healthcare directive. That will is used to protect all their wishes and desires. That trust is used to protect all of their assets. That power of attorney protect their financial decisions so someone can make that for them if they can't. The health directive protect their wishes when it comes to their health. These things are very crucial, guys. Very, very crucial that we make sure that we get these things done for our clients to protect their assets. And ultimately, when it comes down to their debts, we teach them about debt management too. We show them how to manage their debts. We teach them techniques on how to reduce their debts by finding out what's the name of their creditors, name of the balance that is owed, the amount of balance that is owed, what is the APR, and what is the minimum payment. This is their homework. So that way we can show them how to pay down their debts and build up their credits. We teach them the snowball effect. And ultimately, when we find out how much our clients could save every month, Once again, do not be the IUL junkie. Okay? Do not be the person that does think that the IUL is for everybody. You got to make sure that you put together a financial foundation. Sit down with that client and talk about what happened if you die. What happened if you get sick? What if you become disabled? Right? What if you have a disability? And also, how are you going to transfer your wealth? Right? These are the four things we got to talk to our clients about when it comes down to their financial foundation. So when you talk about death, we got to talk about life insurance. When it talks about sickness, we got to talk about health insurance. When it talks about disability, we got to talk about long-term care. When it talks about wealth transfer, we're going to talk about estate planning, right? These are the four things that we help clients to use so that way they can structure these things when it comes to their financial foundation. Now, ultimately, as you continue to learn about life insurance, health insurance, long term care, and estate planning, it is very crucial that you understand that each life insurance have a purpose. Your final expense insurance is something that you can help a client with. It doesn't require blood nor urine for them to get qualified. It's them answering a few questions and probably doing a phone interview, and they could get qualified within the first hour of them even answering those things. You can get them instant coverage. Why? Because that final expense is exactly for what it's for. It pays for their final expenses. It pays out within 48 hours of your passing, by the way. Also, your term insurance. Your term is supposed to be used and structured to cover your dime. Your term is supposed to be used and structured to protect your dime. Your dime is a temporary need that needs to be protected. That can be protected for 10 years, 20 years, and 30 years. Okay? Now, your IUL is not supposed to be structured to protect your dime. It's supposed to be structured to give you growth, safety, protections, and tax advantage of your money at the same time. That's what your IUL is for. If you want to get IUL to be your own bank, it can't be so much driven upon death benefit unless it's designed to open up what's called a 7Pay, so that way you could overfund the policy and really structure it properly. If that's not the reason for an IUL, you don't need an IUL, to be honest. The IUL is supposed to be structured and used to give you growth and safety upon your money with protection and tax advantages. And also make sure that you own any life insurance that has living benefits attached to it, okay? It has to have living benefits. It needs to have chronic, critical, or terminal illnesses, if not all three. But never own life insurance that does not give you living benefits. When it also comes to the health insurance, we got to make sure that our clients understand the difference between an HMO and a PPO. They must understand what is a copay and what's their deductible. They must understand that yes, HMO may be cheaper, but it gives you a lot of restrictions. PPO might be more expensive, but guess what? It gives you a lot more flexibility and freedom. Yes, what is your copay? You got to know what is your copay for visiting your doctors. What is your copay for your prescription? What is your deductible? Most people may not realize that the higher your deductible is, yes, it's a cheaper your insurance, but the way that deductible work is that if you have a $3,000 deductible, if you was to go to like a hospital, you got sick, you have to pay that $3,000 first and then the insurance company will come in after you pay the deductible. So you got to understand these things so you could teach these things. When it comes down to long-term care or estate planning, why the client need a will, right? Because most people think that they need to just have a will. No, you need to have a will, a power of attorney, a healthcare directive, and a trust. And then when it comes to long-term care, very crucial that the client understand why they need to have something in place for if they get chronic, critical, or terminal illnesses. Because where the money going to come from most likely? Either from their savings or it's going to come from their retirement plan. So we want to put a better plan in place. So the questions you need to ask yourself is number one, do you really know your dime? Do you understand HMO versus PPO? Do you have the protections for chronic, critical, and terminal illnesses? And do you want to be a legacy or a memory? because most people don't understand the difference between the two. A legacy is someone that has an estate plan in place. As someone that just wants to be a memory, most likely they probably have a will or nothing. And that's why they only become a memory for one generation, and multiple generations outgrow them, never knew them, nor knew their name. I want every one of you that's listening to this to become a legacy in your family. Become the next J.D. Rockefellers. Become the Vanderbilts. Become the J.P. Morgans. Become somebody significant, the Napoleon Hills, right? Your last name could make a difference. Just like my last name, the Corniffs. I'll be the one that killed poverty, and I want to show you how to kill poverty with me. The goal is for us to kill poverty. And what you should say as an affirmation every day, I am a poverty killer. You know, they say there's three types of PhDs that most people have obtained in their lifetime. And I want to share these PhDs with you. The first PhD is a public high school diploma. The second PhD is that they become passionate, hungry, and determined. And if you understand those two PhD very well, and you realize that those things do not limit you, but it actually should motivate you to become the person who has dough. You got to become the person or the parent that has dough. Become the parent that has dough, the person that has dough. Because you understand that your PhD, your public high school diploma, does not limit you from becoming passionate, hungry, and determined, so that way you can become the person that has dough. That's what financial education does for you guys. It's the ultimate equalizer. So ultimately, once you learn your dime and you learn what's called the dime method, you'll understand why you need to protect all your debts. Make sure that you protect your income for at least 15 plus years. Make sure that you protect the balance of your mortgage and your kids' educational planning. Why? Because God forbid, if you die too soon, you don't want your debts to become someone else's burden. We don't want this for our clients. We don't want our clients to have to make sure that their income disappear for the next 15 years. We don't want our clients to learn why their mortgage balance becomes someone else's burden and then they may become homeless. We don't want our kids to go into debt to seek higher education. So that's why we got to know what we need to protect. If a life insurance agent does not do this with you, they're selling you. If a life insurance agent does not do this with you, they're selling you. And at that moment, if they don't talk about your dime, kick them out at the same time. Kick them out. Because they're not doing something for you, they're doing something that's beneficial to their pockets. So ultimately, guys, like I said, a financial needs analysis. Scan the QR code, complete the financial needs analysis. This needs analysis will help you to learn how to master your money and understand how to win that money game. Okay? And I want to encourage every last one of us, definitely get that done ASAP. Right? So if you'd like to learn more, you can go to our link tree / BShynaz Legacy LLC. And also, if you love to support me in anything that I'm doing, I would love for you to also scan this QR code right here and go out there and get a copy of the book called Conquer Your Financial Future. Master Your Budget with the 50-30-20 budgeting formula. And that book is going to be the ultimate game changer, so that way you understand how to win that money game. So I want to encourage you, scan that QR code, go get the copy of my book, and that book is going to help you to master your budget, so that way you can learn how to win the money game. All right. So if you have any questions, guys, remember that you could text us at 321-312-0130. Once again, if you have any questions, you could text 321-312-0130 or get in touch with your trainer or the person that shared this with you ASAP, so that way they can help you. So with that said, guys, my name is Coach Keyon Corniff, also known as Mr. Finance, your favorite financial educator and business coach. So always remember that the choice is always yours. All right? Keep winning.